Hello, savvy investors. Welcome to HouseLux Estate, your go-to channel for all things real estate and investment. Picture this, a platform where you can dive into the vast ocean of investment knowledge. That's what HouseLux Estate is all about. We are here to provide you with valuable insights into the world of investments, real estate, and financial management. Our mission is to simplify complex financial concepts and make them accessible to everyone, regardless of their background or experience. From the seasoned investor to the novice just dipping their toes into the investment pool, we aim to provide practical tips and strategies that can help you navigate the financial seas with ease. Our focus is not just to inform, but to empower you to make the best financial decisions possible. Today, we delve into a topic close to every investor's heart: how to save money on taxes using smart investment strategies. Before we dive into the strategies, let's get our basics straight. What are taxes and what role do investments play? Taxes, put simply, are compulsory contributions to state revenue levied by the government on income and business profits, or added to the cost of some goods, services, and transactions. They are the lifeblood of government projects and services, from infrastructure to healthcare, education, and social services. Now, let's talk about investments. Investments are essentially your money working for you. When you invest, you buy assets with the expectation that they will generate income or appreciate over time, allowing you to sell them at a higher price in the future. Investments can come in many forms, including stocks, bonds, real estate, mutual funds, startups, and more. So how do these two concepts intersect? Well, the connection between taxes and investments is significant, as the income from your investments is usually subject to tax. This means that the more money you earn from your investments, the more you may have to pay in taxes. However, the relationship between taxes and investments isn't just one way. The tax system also provides opportunities for investors to reduce their tax liabilities. Certain investment vehicles can offer tax advantages, such as tax deductions, tax credits, or tax-free growth. For instance, retirement accounts like a 401k or an individual retirement account often provide tax benefits to encourage long-term saving and investing. Additionally, the timing and type of your investments can also impact your tax bill. For instance, investments held for over a year may be subject to lower capital gains tax rates. Similarly, investing in certain sectors or projects can also offer tax incentives. In essence, understanding the interplay between taxes and investments can help you make more informed financial decisions. By considering the tax implications of your investment choices, you can potentially enhance your returns and save money on taxes. Now that we've got the basics down, we can move on to the main event: smart investment strategies to save on taxes. With a firm understanding of taxes and investments, it's time to explore strategies that could potentially save you a lot of money. One of the most effective ways to save on taxes is to invest in tax-advantaged accounts. These are special types of accounts that provide certain tax benefits. An example of this is a retirement account, such as a 401k or an individual retirement account, IRA. When you contribute to these accounts, you are essentially reducing your taxable income, which in turn lowers your tax bill. An IRA, for instance, allows you to contribute up to $6,000 per year. And if you're over the age of 50, you can contribute an additional $1,000. This money grows tax deferred until you withdraw it in retirement. Then, there's real estate. Investing in real estate can be a great way to receive tax deductions. For example, the interest you pay on a mortgage for an investment property can be deducted from your taxable income. Additionally, any expenses related to the upkeep and management of the property can also be deducted. Remember, though, that while these deductions can lower your tax bill, they should not be the sole reason for investing in real estate. The property should also have the potential to generate a good return on investment. Investing in stocks is another strategy. When you sell a stock for a profit, you generally have to pay capital gains tax. However, the rate at which you're taxed depends on how long you've held the stock. If you've held the stock for more than a year, you'll be taxed at the long-term capital gains rate, which is typically lower than the short-term rate. So holding onto your stocks for a longer period can help reduce your tax bill. Then there are health savings accounts, HSAs, and flexible spending accounts, FSAs. Contributions to these accounts are tax-deductible, and withdrawals for qualified medical expenses are tax-free. HSAs in particular offer a triple tax advantage. Contributions are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. Lastly, consider donating to charity. Not only does this help a cause you care about, but it can also provide you with a tax deduction. If you donate stocks or other assets that have increased in value, you can avoid paying capital gains tax on the appreciated value and also get a tax deduction for the full market value of the asset. Remember though, while these strategies can help lower your tax bill, they should align with your overall financial goals. They should not be pursued solely for the purpose of tax savings. Always consult with a financial advisor or a tax professional to understand the potential tax implications of your investments. Remember, the key to saving on taxes is smart and strategic investing. Let's bring these strategies to life with some real-world examples. Imagine this. Sarah, a small business owner, has been struggling with high taxes. She decides to make use of a self-employed 401k plan, also known as a solo 401k. By contributing a significant portion of her income to this plan, she not only saves for her future, but also reduces her taxable income. At the end of the year, Sarah was pleased to find that her tax liability had considerably decreased, all while growing her retirement savings. Then there's John, a high-income professional. John was looking for ways to reduce his tax burden, so he decided to invest in real estate. By purchasing a rental property, he was able to deduct mortgage interest, property taxes, and even some costs associated with maintaining and managing the property. This strategy helped him save a significant amount in taxes, while also providing a secondary income stream. Another example involves Jane, a savvy investor. Jane understands the power of long-term investment, and so she opts for index funds. These funds are not only known for their lower fees, but also their tax efficiency, as they tend to have lower turnover rates. Jane holds onto her investments for more than a year, meaning she benefits from lower long-term capital gains tax rates. This strategy helps her save on taxes while growing her wealth over time. Lastly, consider the case of Mike, a retiree. Mike decided to move his savings into a Roth IRA. While he had to pay taxes up front, all future withdrawals in retirement are tax-free, including the gains. This strategy has allowed Mike to enjoy his retirement without the worry of a tax bill on his withdrawals. These examples show that with the right strategies and a bit of planning, saving on taxes is entirely achievable. Whether you're a small business owner like Sarah, a high-income professional like John, a long-term investor like Jane, or a retiree like Mike, there are tax-saving investment strategies that can work for you. So, why not start planning your tax-saving strategy today? We've covered a lot today, so let's take a moment to recap. We started by welcoming you all to HouseLux Estate, where we aim to provide you with knowledge that can help you make better financial decisions. We then jumped straight into understanding the basics of taxes and investments. We stressed the importance of having a firm grasp of these concepts, as they form the bedrock of any smart investment strategy. We delved into the different kinds of taxes that can impact your investments, including income tax, capital gains tax, and estate tax. We also explored various types of investments from stocks and bonds to real estate and mutual funds. We emphasized that each investment type has its own tax implications, and understanding these can help you maximize your returns and minimize your tax liability. Next, we moved on to discussing specific investment strategies that can help you save on taxes. We highlighted the power of tax-deferred and tax-exempt accounts, such as individual retirement accounts and health savings accounts. We also underlined the benefits of long-term investing, which can help you take advantage of lower capital gains tax rates. To give you a clearer picture, We shared real-life examples of how these tax-saving investment strategies can work. We walked you through scenarios that showed the potential savings you could achieve by using these strategies. These examples serve to illustrate the significant impact that smart tax planning can have on your overall investment returns. Remember, understanding taxes and investments is not just about saving money. It's about empowering yourself to make informed decisions that can secure your financial future. It's about investing smart and saving big. That's it for today's video. Don't forget to subscribe to HouseLux Estate for more investment tips and strategies. Until next time, invest smart and save big.